now it seems to work. So sorry for that. It was a problem with the internet connection. Hopefully it will work now. But okay, so I will let's see where we have our slides, and then we can go on. So sorry, but there was a problem. But now you can hear me, I hope, and I also hope that you can see the slides again. Can you see the slides now? Hello? Hello? Can you hear me? And can you see the slide? Yeah, okay, cool. So sorry for that, but I hope now the connection will be stable. I couldn't open this program, and probably it was because of the internet connection. Nevertheless, I think we were here. At the impairment slide. So whenever the recoverable amount is lower than the book value, you have to write it out, and this is called an impairment loss. Yeah, so this is called an impairment. This is called an impairment loss. And this is a related journal entry. This is the related journal entry. You debit an impairment loss, and you credit accumulated depreciation and impairment loss. If you see the accounting equation, if you see the elements of the accounting equation, can you tell me what is affected here? Which elements are affected here? When you debit impairment loss, yeah, okay. So an asset, when you credit accumulated depreciation and impairment loss, this is a contra account to an asset. So Liang is right. Contra account. This is a contra account to an asset. So asset is down, and impairment loss is an expense. Yeah, it's a loss rather. But this reduces our reduces our net income, and essentially reduces our equity. So let's talk about the revaluation model. So far we talked about the cost model, but this is the revaluation model. So the revaluation model is different, as it recognizes the asset with the fair value. Yeah, fair value means that whenever the value changes, yeah, so whenever the value fluctuates over time, that you have to recognize this. You have to recognize this value. Yeah, so you have to put this value on the balance sheet. Yeah. So the question is, how often do you have to evaluate whether the price, whether the value of the asset has increased or whether it has decreased? And IFRS has, in general, every 3 to 5 years, but more frequent if the value of the asset is volatile. So what does volatile mean? What does volatile mean? Unstable, yeah, unstable. Volatile means it fluctuates a lot. Yeah, very good. So it is kind of unstable. Yeah. So, and if one item is revalued, one item of property, plant, and equipment, then the entire class shall be revalued. Yeah. So there is no cherry picking. Yeah. So the entire class has to be revalued. So this no cherry picking. Yeah. No cherry picking. So how to the question is how to recognize the changes in value if you use the fair value, the revaluation model. Generally, if an asset's carrying amount is increased, then the increase shall be recognized in other comprehensive income. Yeah, in other comprehensive income. And it's called revaluation surplus. So that means essentially, if you have an asset and this is the cost, and the asset increases in price, then this increase doesn't go into the profit and loss. It doesn't go into the income statement. Yeah. So it goes into other comprehensive income. Other comprehensive income means not the income statement. Yeah. When it increases, it's not the income statement. If an asset's carrying amount is decreased, yeah. So this is if it's decreased. Let's do it here. If this is cost and it's decreased, it goes down. Then the decrease shall be recognized in profit and loss. Yeah. So then it goes into the income statement. Into the income statement. And then, but the next sentence says, however, the decrease should be recognized in other comprehensive income. Yeah, so not in the income statement, to the extent of any credit balance existing in the revaluation surplus in respect of the asset. So if you have a revaluation surplus, that means we are here, and then it goes down, then this is also in OCI, not in the income statement. Yeah. So generally, you can say, if it is increased, yeah, then above the original cost, then it is OCI, yeah, not through the income statement. If it is below the book value, then it is profit and loss. Then it flows through the profit and loss, and it decreases your earnings per share. Yeah. Generally, does that make sense? Does that make sense to you, or are there any questions? Do you understand what the difference is between the income statement and other comprehensive income? what is the difference between the income statement and other comprehensive income? The income statement is generally if you have expenses and if you have revenues, income. That's the general profit and loss statement. But there is other comprehensive income. You also call that dirty surplus accounting. And that means that essentially there are some things which are not related to the core business. And the standard setter says, okay, if these things are not related to the core business, then they are probably not that important. And therefore they shouldn't be shown in the income statement. And if they are in other comprehensive income, then they do not influence earnings per share. Yeah. And all the people, all the analysts, all the financial community focuses on earnings per share. Yeah. So that means other comprehensive income is, the standard setter says, okay, it is income, but it's not as important as the net income. Yeah. That's why as the income statement, that's why it's called other comprehensive income. Yeah. So other comprehensive income is other income, which is not as important. Yeah. And not every change in equity flows through the income statement. That's why we have other comprehensive income. Yeah. And that's why it's sometimes called dirty surplus accounting, because not every change in values flows through the income statement. Yeah. And when we're talking about the revaluation model, then we have to be aware that increases above the book value, that they are shown in other comprehensive income and not in net income. When we have decreases, yeah, then the standard setter says, okay, we have to be careful. And when we have a decrease, we should show that our shareholders in the income statement. Yeah. Are there any questions? Do you understand the idea of other comprehensive income? Exactly, yeah. Yeah. Increase is not income related to the income statement, but decrease is a loss in the income statement. So an increase at least does not flow through the income statement. Yeah. The standard setter IFRS says, okay, if we have an increase, this is not our normal income, because I mean, think about it. Let's say we're talking about BMW now, BMW, and the machinery or the building increases in price. The building increases in price. The standard setter says, okay, if a building increases in price, in value, then BMW shouldn't show this in their income statement, because this is, I mean, this is a rather arbitrary value. This is like, this is at least not the core business of BMW. This is not the core business. The core business of BMW is selling cars. And prices can fluctuate of buildings or of real estate values. And therefore, they shouldn't put at least the increase in their income statement, because it can go up and it can go down. And you should be conservative. Yeah, you should be conservative. And that's why you should be conservative, because you should be cautious. And that's why only losses decrease your net income, but increases do not increase your net income. Yeah, so that's the idea behind it. Yeah, so there is net income and other comprehensive income. And this is a very important concept, because the standard seller says, okay, there is some income which should not flow through our net income. It should not influence our net income. And this is other comprehensive income. Yeah. These are the journal entries for disposal of property, plant, and equipment. So if a company gets rid of property, plant, and equipment, it gets cash. Yeah, so debit cash. And in the first case, the cash the company gets is 900. Yeah. The book value of the machinery is essentially 1,000. Why is it 1,000? Because 3,000 minus 2,000. So 3,000 minus 2,000 equals 1,000. Yeah, so this is the book value. Yeah, before selling the asset. 1,000 is the book value. And our price we get is 900. Yeah. So if we have a price of 900 and our book value is 1,000, then we have a loss of 100. Yeah, we have a loss of 100, and the loss of 100 goes into our income statement, reduces our equity. Yeah. So we have to debit it because it's a loss. It reduces our equity. Yeah. So this is the first case. And in the first case, we have a loss. Why we have a loss? Because the amount of cash we get is lower than the 1,000. The second case, we have a gain. We have a gain of 300. And why do we have a gain? Because here the cash we get is more than 100. Yeah, is more than 1,000. Yeah, because again here the book value is 1,000. 1,000 is 3,000 our machinery minus the accumulated depreciation. If we get 1,300, 1,300 is more than 1,000, and we have a gain of 300. We have to credit because it increases our equity. Yeah, it is shown in the income statement and increases our equity. Does that make sense? Do you understand the journal entries? Or are there any questions? Do you understand this? Clear. Okay. Okay. Very good. Then let's go on. Here we have a couple of exercises for you. Start with the first one. Which financial statement covers a period of time? Think about it. Think about it. And then tell me what is the correct answer. Okay. So what is the correct answer here? Yeah, Liang says D, and this is correct. Yeah, this is correct. The income statement is about a period of time, and the cash flow statement is also about a period of time. The income statement shows the performance of the company, shows the net income of a company over a given year, and the cash flow statement shows the cash inflows and outflows over a given year, over a period. The balance sheet, what about the balance sheet? Is the balance sheet also a period of time? Or what is the balance sheet? It stays, yeah. It is I would call it a snapshot. Yeah, it's kind of called forever, but I would call it a snapshot. And it is at a point in time. Yeah, point. in time. That's the balance sheet. Yeah, but the correct answer, as Liang said, is D. Yeah, both B and C cover a period in time. Correct. Very good. And this is the next one. What is the effect on the financial statements of recording depreciation on equipment? Think about it. Okay, we're talking about depreciation here. Assets and shareholders' equity is decreased. What about, because assets go down? Yeah, assets go down. Shareholders' equity also goes down. What about net income? Think about it. Liang, if you think about net income, is it also going down because of depreciation? What about net income? When you have depreciation, what is depreciation? Depreciation is an expense. Does it decrease net income? Yes, it does. Yeah. So net income, assets, and shareholders' equity are all decreased. Yeah. So it's C is the correct answer, because net income is also decreased because depreciation is an expense. Yeah, depreciation is an expense. And expenses decrease. That makes sense? No. Yeah. Okay. During the year, EcoWash has 120,000 in revenue, 50,000 in expenses, and 4,000 in dividend payments. Shareholders' equity changed by what amount does shareholders' equity change? Think about it here. What is the correct answer? $66,000. Yeah. Very good. This is correct, Liang. And can you tell me why? How did you come up to 66,000? Okay, 120 minus 50. 120 minus 50 is your net income. And minus 4, because generally net income increases your equity, but not if it's paid out as a dividend. Yeah, not if it's paid out. Not if it is paid out as a dividend. This is the next one. During the year, EcoWash has 120,000 in revenue, 50,000 in expenses, and 4,000 in dividend payments. Shareholders' equity changed by this is the next one. During the year, EcoWash has 120,000 in revenue, 50,000 in expenses, and 4,000 in dividend payments. EcoWash had a net loss of 50,000, net income of 70,000, net income of 66,000, or net income of 120,000. What is the correct answer here? Think about it. The last question was about how shareholders' equity changed. This one is about the net income. What is the net income? Here. What is the net income? Think about it and then tell me. What is the correct answer here? What is the correct answer? Think about it, Liang. How do you come up to the net income? What is, if you think about the income statement? What is your net income? Your net income is all the income minus all the expenses. Yeah, all the income minus all the expenses. So all the income here is revenues, which is 120,000. 120,000 minus the expenses, and the expenses are 50,000. And that brings you to the correct answer, which is 70,000. Yeah. So 70,000 is the correct answer. 70,000 is the correct answer. Dividends do not matter here. Yeah. Dividends are paid out of net income. Yeah. Dividends are paid out of net income. Are paid out of net income. Yeah, they are a form of distribution. Yeah, how you distribute your net income, you give it back to the shareholders. But dividends do not reduce net income. Yeah, dividends do not reduce your net income. Yeah, so B, net income of 70,000 is correct. Yeah, net income of 70,000 is correct. This is the next one. Chavis company had total assets of 340,000 and total equity of 130,000 at the beginning of the year. During the year, assets increased by 70,000 and liabilities increased by 25,000. Equity at the end of the year is. Think about this. I give you 5 minutes. Try to answer this one in the next 5 minutes. Try to answer this one in the next 5 minutes. Okay, so let's see. I think we can do this with the accounting equation. Yeah, we have assets equals equity plus liabilities. So the beginning of the year, this is the beginning. We have 340. And total equity of 130. What is liabilities at the beginning of the year? What is liabilities? Liabilities is 210, exactly. Good. So this is the beginning. Then we have the change of the year over the year. During the year, it says assets increased by 70,000 plus 70,000. Liabilities increased by 25,000. Yeah. So let's see what we have at the end. So here we have assets of, what is it? 410. We have liabilities of 235. And we have equity. If we solve our accounting equation, 410 minus 235. So the answer is 175. Yeah. So C is correct. Very good. Yeah. Excellent. So very good. So this is the next exercise. Try to solve this exercise first on your own. Here we have the company Amir Communication, and on January the 1st, 2016, the company purchased a new piece of equipment that costs 45,000. The estimated useful life is 10 years, and estimated residual value is 5,000. What is the depreciation expense for 2016 if Amir uses the straight line? Yeah. It is 40. K minus 5K. Divided by 10. And the correct answer is 4K. Yeah. So you have to deduct the residual value in order to calculate the depreciation expense. Yeah. So this is correct. This is the next question. If Amir uses the straight line method for depreciation, what is the assets book value at the end of 2016? D. Okay. What did you calculate? How did you come up? Yeah. Okay. Yeah. So it's 45K minus 2 times, because we have 2 years, 4K, because 4K is the depreciation expense for 1 year, and the correct answer is 37K. Yeah, very good. This is the next one, and this one is about the units of production method. So here it's not about the useful life, and depreciation isn't affected by the useful life, but rather it's affected by the units of by the units of production, or by the output. So try to solve this one. A company purchased an oil well for 270,000. It estimates that the well contains 90,000 barrels. If the company extracts and sells 10,000 barrels of oil in the first year, how much depletion expense should be recorded? Use the units of production method. So try this one. Okay, D. So the total output 90,000. 90,000 is the total output. Yes, total output. Total output. If the company extracts and sells 10,000, so 10,000 is 1/9 actually. Yeah, so 10,000. So then the correct answer is 30,000. Yeah, why? Because 10,000 divided by 90,000. 90 is okay. 90,000. 10,000 divided by 90,000 times, this is times 270,000 equals 30,000. Yeah, so D is the correct answer. This is the next one. Which of the following assets is not subject to decreasing book depreciation, depletion, or amortization? Is it land improvements? Is it goodwill? Is it patents, or is it natural resources? What do you think? What is not subject to a decreasing book value? Where does the book value not decrease? Where does it not go down? Which of those is not depreciated? Okay, first of all, it's for example a fence. Yeah. Fence lose value over time. Does the fence lose value over time? We talk about depreciation when we're talking about fixed assets. What about patents? Do you think patents? Patents is also copyrights, yeah. Patents is intangible assets. It is amortized, yeah. It is amortized. patents is amortized because it has a useful life. Natural resources is, for example, an oil well. Yeah, this is natural resources, and it's depleted. Yeah, what does not use value is the goodwill. Yeah, goodwill does not lose value. What is goodwill? Do you have an idea what goodwill is? Exactly. Yeah. Goodwill and business reputation. Goodwill is amortized. Goodwill. Yeah. Good. It's not amortized. Goodwill is not amortized. So B is correct. Okay. I would suggest this one. This one is over, but I would suggest we start with the next section because we had an interruption because of the bad connection with the internet. So let us start with the next section, and the next section is intangible assets, and here we are at those assets that are not intangible. Yeah, that are not tangible, that are intangible. So patents, for example. Yeah, patent is an intangible asset. What can you name other intangible assets? Goodwill, exactly. Yeah, goodwill. Licenses. Yeah, if you have a license. Yeah, so these are all intangible. For which sector or company do intangible are which are the sectors is important? Think about intangible assets are especially important. About patents. For which industries or which sectors do you think intangible assets are particularly important? Is it banks? Is it consumer products? Which industries do you think are especially reliant on intangible assets? Which industries industries are big in R&D, for example. Exactly, Huawei. Yeah, very good example. Yeah, Huawei is. Well, I hope I can put it. Huawei is a tech company. Yeah, it is in tech. So first, intangible. What are intangible assets? Intangible are identifiable assets. It is long-lived assets. Yeah. So here they are also long-term. Yeah, like property, plant, and equipment. But you cannot touch them. Yeah. So they are without physical substance. And examples are, as Liang has said, patents, yeah, trademarks, or goodwill. What is a trademark? The McDonald's arch. Yeah. So this stands for TM. Yeah. Or think about this is, yeah, exactly, the golden arch. Think about this. This is Nike. My drawing is very bad, but you can. This is also a trademark. Yeah. Trademark means you are not allowed to use it. Yeah. So this is trademark. Well, it's only allowed for Nike to use this. What is it called? Swoosh or whatever. Yeah. So, and initially, those intangible assets, they are recorded at acquisition costs. Yeah, initially they are recorded at acquisition costs, like any other assets. Yeah, like any other assets. Initially, if you can record them, then they are recorded at acquisition costs. And for subsequent measurement, for later measurement, firms have to choose. It's similar to property, plant, and equipment, between the cost model and the revaluation model. So have to choose. Yeah, but IFRS says it should be very rare to be able to use it. Yeah, so IFRS says revaluation only if there is an active market. Only if there is active market. only if there is an active market, then you are allowed to use the revaluation model. What could be an active, or what does an active market mean? What does an active market mean? IFRS, it fluctuates, yeah, but active markets also means that those assets have to be sold frequently. Yeah, only if they are sold frequently, then you can talk about of an active market. And then IFRS says you are only allowed to use revaluation model, to use the revaluation model if there is an active market. Market, yeah, only if the assets are sold frequently, and mostly with intangible asset, there is no active market, because there, I mean, the Nike swoosh is not sold all the time, or the golden arch of McDonald's. Yeah, it's not sold, or there is no active market at all. Yeah, and also for patents, is there an active market? Is it sold often? Are patents often sold? Probably not. Yeah, probably not. Patents are given out to companies, but they are not sold often. Yeah. So unless there is an active market, the firms have to choose the cost model. Yeah, and the cost model, very similar to property, plant, and equipment. The cost model says you should use the cost minus accumulated amortization minus accumulated impairment costs. So this is the book value. Yeah, so this is the book value. Yeah, book value equals book value, or carrying amount, equals costs minus accumulated amortization minus accumulated impairment costs. When we're talking about intangible assets, we have finite lives and we have indefinite lives. Yeah, when we have finite lives, we have to amortize them. Yeah, finite lives means the time span, the life of those assets, they can be measured reliably. Yeah, but note that here it doesn't say infinite lives. It doesn't say that the life goes on forever, but rather it says they are undefined, indefinite lives. Yeah, it's not defined. Yeah. So here, amortization of indefinite life. This is goodwill, for example, e.g. goodwill. Here, amortization. Do you have an example for an asset with a finite life? A patent, exactly. Yeah, patent is here. and both categories are subject to impairment test. Yeah. So generally speaking, the impairment test is the same as with property, plant, and equipment. Yeah. So the impairment test is the same as with property, plant, and equipment. So you should be familiar with it. Yeah. Here, this is the impairment tests. The asset must not be carried at more than recoverable amount. Yeah. So the same as with property, plant, and equipment. Yeah. And recoverable amount is the higher amount of use or sale of an asset. Again, the same as with property, plant, and equipment. If the carrying amount, the carrying amount is the book value, the value on the balance sheet, is higher than the recoverable amount, then there has to be an impairment. Yeah, so then there has to be an impairment, and impairment means write down. Yeah, so write down has to be written down. Yeah, the only difference is unlike property, plant, and equipment, there is no reversal of impairment. Yeah, there's no reversal. Yeah, so you are allowed to the impairment whenever it's written down, and so and there is no reversal of the impairment between the difference between property, plant, in plant equipment you have when you in the period so you out that actually higher than what it is, write it up. Yeah, but with intangible assets this is not allowed. Yeah. Are there any questions to impairments? Are there any questions related to impairments? So you compare the book value. You compare the book value, which is the carrying amount, to the recoverable amount. If the recoverable amount is lower, you have to do an impairment. You have to write it down. Yeah. And the recoverable amount is the higher value of using or selling the asset. Yeah. Using means you estimate all the future cash flows and discount them to the current time, and selling price is whatever you get for the assets. Yeah, does that make sense? Is it clear or not? Impairment is a write-down. Okay. Yeah, the internet seems to be really bad today. Internet seems to be bad. But I hope this will be better to tomorrow. Yeah, I think let's do 5 more minutes and then we stop. But I do a little bit longer today because we had this interruption. Yeah. So this is specific subcategories of intangible assets, and let's start with patents. Patents are granted by the government or by a related agency. In Germany, it's the Patentamt, and a patent gives the holder an exclusive right for a certain number of years to produce and sell an invention. Yeah, and a patent has to be amortized. Yeah, maybe purchased. This is the related. You debit your patent and you credit cash. Yeah, so if we are here, we are here. Asset goes up and asset goes down. Yeah, patent is an asset, cash is an asset. When you later amortize the patent, then which elements of the financial statements are affected here? Yeah, equity goes down, correct? Yeah, because of amortization. Amortization is an expense, yeah, and an expense reduces our equity. Expense reduces our equity, and the patent is an asset. Yeah. Yeah. So this is correct. And this is the second subcategory we're going to talk about, is trademarks and trade names. Now we are at the Nike, the swoosh. Yeah. So, and it is a logo or something like that, a distinctive identification of a product or service. Yeah. Or think about Coca-Cola's dynamic ribbon. Yeah. And so it's often marked with the TM. Yeah. And so some trademarks have indefinite lives and others not. Yeah. Goodwill. I think we're gonna talk tomorrow about goodwill. So we will continue. We will continue tomorrow. The next session is tomorrow at 9 a.m. Yeah, 9 a.m. German time. So see you tomorrow. bye-bye. 9 a.m. German time, and I hope then that the internet is better and we have a better connection. So enjoy your evening, and see you tomorrow. Bye bye. Young, you said you have a class called digital innovation. Yeah, but in my timetable it says it's 9 a.m. Our class. I will. So yeah, we will hold our class and choose whatever you like. I will ask the person who is responsible, but last time they said me my timetable is okay. And so